Okay, so you've all sent in some seriously interesting stuff this time around. It looks like we're diving deep into the stock market today. And we even have a super detailed Wikipedia article in the mix, which is always a great place to start, right? So I guess our mission today is to, sort through all of this, pull out the most important and, well, the coolest bits, and kind of try to give you a shortcut to really understanding how the stock market ticks.
Yeah, exactly. I mean, we're going to try to be your guides to the core knowledge here and synthesize all this info into something really digestible.
Perfect. And, just to kick things off with a little fun fact that really blew my mind. Did you know that the total value of every single publicly traded stock in the entire world, like everything, went from just $2.5 trillion in 1980 to a mind-boggling $111 trillion by the end of 2023? I mean, talk about a growth spurt. And I think that really shows just how huge and, well, how crucial the stock market is these days, doesn't it?
It really does. It highlights the incredible evolution of the global financial system, and the stock market's absolutely central role in all of that.
Totally. So, in this deep dive, we're going to cover a lot of ground. We'll start with the basics, like what exactly is a stock market and what does it actually do? Then we'll take a quick trip back in time to see where it all began, explore the nuts and bolts of how it operates day to day, meet the key players involved, and figure out what motivates people to get involved in the first place. Then we'll tackle the exciting and sometimes, well, terrifying world of stock prices, including those infamous crashes. And finally, we'll touch on some of the different strategies people use to navigate this whole investing game. So first things first, can you break down what a stock market actually is? I mean, it sounds pretty self-explanatory, but is it really?
Right. Well, at its core, a stock market, you might also hear it called an equity market or a share market, is basically just a place, real or virtual, where people who want to buy and sell stocks can come together. And it's really important to remember that stocks or shares are little pieces of ownership in businesses. So when you buy a stock, you're literally buying a tiny slice of that company.
So it's all about ownership then.
Exactly. And it's not just about those big name companies you see listed on the public exchanges, the ones always making headlines. It also includes privately held companies, the kind that might be traded through things like equity crowdfunding platforms.
Oh, I see. So it's this whole ecosystem for exchanging ownership, and it encompasses all kinds of businesses, big and small.
Right, exactly.
Okay, so then what's the big deal about all this buying and selling? What's the main point of having this whole stock market system?
Well, the main idea is to make it easier for people to exchange these pieces of ownership, these securities, between those who want to buy and those who want to sell. It's like a giant organized marketplace designed to make these transactions smooth and efficient. And maybe even more importantly, these exchanges constantly share real-time information about what's being traded and at what price. So it's like a constantly evolving snapshot of how much those ownership shares are worth.
Got it. It's like this dynamic way of figuring out prices based on who's buying and who's selling.
Yeah.
Okay, so let's zoom out a little bit. What does the stock market world look like globally? Are we talking dozens of exchanges? Hundreds?
Well, as of 2016, there were about 60 stock exchanges operating all around the world. But here's the interesting part. A relatively small number of those exchanges actually account for the vast majority of the market's total value. Just 16 of them held a market capitalization of like $1 trillion or more, which together represented a whopping 87% of the entire global market cap. So basically, these big players hold most of the cards.
Wow, that's a small group holding a lot of power. So geographically, where are these major players mainly concentrated?
Well, aside from the Australian Securities Exchange, all of those top 16 exchanges are in North America, Europe, or Asia.
So pretty concentrated playing field.
Yeah.
And if we look at the landscape by country, who are the biggest players?
As of January 2022, the U.S. was the undisputed champion, making up almost 60% of the total global market cap. Japan was a distant second at about 6.2%, followed by the UK at roughly 3.9%. That really tells you something about the dominance of the U.S. market.
It definitely does. And you mentioned earlier that companies might choose to list their stock on multiple exchanges, even in different countries. Why would they go through the hassle of doing that?
Think of it like casting a wider net. When a big company lists its shares on multiple exchanges, especially international ones, it's trying to attract more investors, especially from different parts of the world. So by having their stock available in New York, London, and Tokyo, for example, they can tap into a much more diverse pool of investors, which also makes their shares easier to buy and sell.
Right, makes total sense. More visibility and easier trading, and you get more investors. So let's get down to the nitty-gritty here. How do these stock exchanges actually work on a day-to-day basis? I mean, we always hear about the New York Stock Exchange, the NYSE, and NASDAQ. What's the main difference between how they operate?
Well, historically, some exchanges, like the NYSE, had this big physical trading floor, a place where brokers would actually meet face-to-face to make trades happen. Now, while the NYSE still has a physical presence, they've incorporated electronic trading into the mix, so it's kind of a hybrid system. On the other hand, exchanges like NASDAQ are fully electronic. Everything happens through a network of computers. There's no physical trading floor at all.
Oh, interesting. So on a physical floor like the NYSE, how does a trade actually happen in that sort of hybrid environment? Like who's doing what, where?
Well, any orders that are sent to the floor are handled by floor brokers, who then submit them electronically to a specific trading post. Each stock has its own designated spot. And get this, each stock on the NYSE also has something called a designated market maker, or a DMM. Think of the DMM like a designated backup buyer or seller, always ready to make a trade to keep the market running smoothly. The DMM basically has to maintain what they call a two-sided market, which means they need to be ready to buy or sell when there aren't enough other buyers or sellers at a certain price. So if there's a gap between what the highest buyer is willing to pay, that's the bid, and the lowest price the seller wants, that's the ask, the DMM might even step in with their own shares or cash to bridge that gap and make the trade happen. Once it's done, the trade details are sent back to the brokerage firm, and that's how the investor knows the deal is sealed.
So the DMM is like this crucial go-between, making sure things keep moving even when there's a bit of an imbalance, right? And what about on a fully electronic exchange like NASDAQ? How does it all work without a physical floor?
Well, the basic principle is actually similar to the NYSE, but it all happens electronically. So instead of having one DMM for each stock, NASDAQ has multiple market makers competing with each other. And these guys are constantly quoting bid and ask prices for the stocks they're registered to trade. They're always ready to buy or sell at those prices, which keeps the market flowing.
Okay, so it's like a network of firms all constantly bidding and offering, creating this ongoing liquidity. You also mentioned earlier that the Paris Bourse moved to automation. Was that a big moment in how stock exchanges evolved globally?
Oh, absolutely. Back in the day, a lot of exchanges, including the Paris Bourse, which is now part of Euronext, used to operate using what they called open outcry. You can picture this chaotic room with brokers literally shouting their prices at each other, trying to make deals. But the Paris Bourse changed everything in the late 1980s when they automated their trading system. And this shift from all the shouting to fully electronic platforms has basically happened across the globe. I mean, who needs all that yelling when you have computers, right?
It's definitely a different world now. So what happens when trading occurs outside of these big organized exchanges? You mentioned over-the-counter or OTC markets. How do those fit into the picture?
Yeah, so the OTC market is basically an alternative to the formal exchanges. In OTC trading, the deal happens directly between two parties, often through a network of dealers and without the oversight of an exchange. It's more common for securities that maybe don't meet the straight listing requirements of the big exchanges, or for more niche or less frequently traded instruments, maybe even riskier ones.
So it's a bit more, decentralized and less regulated, right?
Yeah.
And you also mentioned something called third markets. What were those all about?
Yes. Third markets, like Instinet, Island, and Archipelago, which are now part of NASDAQ and the NYSE, actually, they popped up as electronic communication networks, kind of like private clubs for big institutional investors. They could trade directly with each other and bypass the traditional exchanges altogether, saving money on those hefty commissions. But of course, there's always a trade-off. This also introduced more risks, like adverse selection, where one party might have more info than the other. These third markets, along with other off-exchange venues like dark pools, where you can't actually see the trading activity, have been under scrutiny lately from regulators. They're worried about transparency and market fragmentation, having things too spread out.
Interesting. So it's this constant balancing act between innovation, efficiency, and then, the need for transparency and regulation. Sounds like a tricky situation. So who are the main players in these stock markets? I mean, it's not just individuals like us, right?
Definitely not. It's a pretty diverse crowd. You have your retail investors, of course. Those are the individuals trading for themselves. But a huge chunk of the action comes from what they call institutional investors. We're talking big organizations like banks, insurance companies, pension funds managing all those retirement savings, hedge funds with their fancy strategies, mutual funds pooling money from lots of different investors, and those exchange-traded funds, or ETFs, that track specific market indexes. Then you have investor groups and other types of financial institutions, and even the publicly traded companies themselves who sometimes buy and sell their own shares. And in recent years, we've seen the rise of robo-advisors, which are basically automated investment managers.
Wow, that is a lot of players, each with their own agendas and approaches. And you mentioned earlier some data about the growth of the global stock market value back in 2021. What did that tell us about who was driving that growth?
Well, in 2021, the total value of the world's stock markets shot up by a huge 26.5%, which added something like $22.3 trillion to the market cap. Both developing and developed economies contributed to this growth. Developing economies added about 9.9 trillion of that, while developed economies chipped in around 12.4 trillion. And if you look at it geographically, Asia and Oceania saw the biggest piece of this growth, about 45%, followed by Europe at 37%, then the Americas at 16%, and Africa at 2%.
So it was a global phenomenon with everyone joining in. But what makes individuals and companies want to participate in this whole stock market game in the first place? What are the driving forces?
Well, there are quite a few factors, actually. Obviously, the current trading prices matter, the general market sentiment, whether people are feeling optimistic or pessimistic, and how much information is available about how the stock exchanges work. But I think a core motivator for many individuals is the potential for higher returns compared to, say, keeping your money in a savings account or investing in bonds.
Yeah, that makes sense. People want to see their money grow faster, not just sit there.
Exactly. And it's not just individual choice. We also see regional and country-specific factors, like in the U.S., for example, where participation rates vary quite a bit from state to state. That tells you that local economic conditions and even social influences can play a part. Interestingly, research shows that just the direct costs of investing, things like brokerage fees, don't fully explain these differences, which points to other things at play.
Right, so it's more than just the money.
Yeah.
You also mentioned behavioral factors earlier. How does our psychology affect our investment decisions?
Well, behavioral economics, which is this fascinating field, shows us that psychological biases play a big role. For example, if you look at countries like Ghana, where stock market participation is pretty low, it suggests that things like cultural attitudes towards risk, how much people understand about finance, or even their trust in the financial system could all be major factors.
It's amazing how much our psychology, our deeply ingrained biases, can affect something as seemingly rational as finance. And then, of course, there are the big picture economic conditions. How do things like a country's natural resources or its political stability play into all of this?
Those are definitely crucial. Things like a country's natural resources, its workforce, technology, all of the what economists call factor endowments, and also its geographic location, political stability, trade policies, how much foreign investment it attracts, and the strength and diversity of its industries. All of these things make its stock market more or less appealing to investors, both domestic and international.
Got it. So a stable and growing economy with good policies is more likely to have a thriving stock market. Now let's talk about how people actually go about investing. You talked about direct and indirect investment before. Can you break those down and explain why someone might choose one over the other?
Sure. Direct investment is just what it sounds like. You directly own shares of individual companies. You make all the decisions about what to buy and sell. With indirect investment, you're putting your money into things like mutual funds or ETFs, which are basically baskets of different stocks managed by someone else. So you're trusting a fund manager or an index to make those investment decisions.
Okay, so direct is DIY investing, and indirect is like hiring a professional. Has the popularity of these two approaches changed over time?
It's interesting. In the U.S., between 1992 and 2007, direct stock ownership by households didn't really increase that much. But indirect participation through retirement accounts like 401ks and pension funds saw a much bigger jump.
Huh. That's a pretty significant difference. What do you think caused that big shift towards indirect investing through retirement accounts?
It seems like the main driver was how these investments are taxed. Money in many retirement accounts grows tax-deferred, which means you only pay taxes when you withdraw it in retirement. But if you buy stocks directly, you usually have to pay taxes on any dividends you receive or profits you make when you sell. So it makes sense that people would prefer the tax advantages of retirement accounts.
Right. The tax benefits definitely make retirement accounts more appealing, especially for long-term investing. You also mentioned earlier that there are differences in stock market participation based on income and race. What did the data show?
Well, data from 2007 and 2011 showed some pretty significant disparities. For instance, not many households in the lowest income bracket owned stocks directly, but a slightly larger percentage held stocks indirectly through retirement plans. And then on the other end of the spectrum, households in the highest income bracket had much higher rates of both direct and indirect ownership. We saw a similar pattern when looking at race and ethnicity, where white households were much more likely to own stocks directly compared to Black or Hispanic households. And the same trend held true for indirect ownership through retirement accounts.
Those are pretty big differences that raise some important questions about access and wealth distribution. What do you think are some of the reasons for these gaps in participation?
There are probably several factors at play. Research suggests that even small fixed costs associated with investing, like those pesky account maintenance fees or minimum investment amounts, can be a real obstacle for lower-income households. Also, there's a strong link between education level and stock market participation. It seems that people with more education tend to feel more comfortable navigating the market. And then there's the social aspect. If you're surrounded by people who invest, you're more likely to do it yourself. It's like knowledge diffusion. You learn from others, and it feels less intimidating to get started.
So it's not just about having the money to invest, it's also about having the knowledge, the right social network, and overcoming those initial hurdles. Okay, let's shift gears a bit and go back in time. The stock market we know today, all digital and fast-paced, obviously had a much longer and more gradual evolution, right?
Oh yeah, definitely. We can actually trace the origins back pretty far. Back in 12th century France, they had these guys called courtiers de change, who were essentially brokers managing agricultural debts for banks. They also traded those debts, so you could say they were some of the earliest predecessors of modern stock traders.
Wow, so it all started with managing and trading debt. Fascinating. And where does the term bourse come from, the word often used for European stock exchanges?
That's a fun one. The term bourse actually comes from a family named the Van der Beurs family who lived in Bruges, which is in Belgium now. They were big-time merchants, and their house became a central meeting point for traders from all over. Over time, the family name in their house became synonymous with trade and finance, and bourse spread to other languages, often becoming the word for a purse or money bag.
So a family name became the word for the stock market. That's a great little historical tidbit. And when did actual securities start being traded?
Well, in the mid-13th century, Venetian bankers started trading government securities. Then, by the 14th century, other Italian city-states like Pisa, Verona, Genoa, and Florence got into the game, trading government debt. They were all independent city-states, not ruled by kings, but by councils of citizens, which made things easier. Italian companies were also pioneers in issuing shares of ownership, with England and the Low Countries following suit in the 16th century. This was also when joint stock companies became really important, especially for funding those big colonial expeditions to the Americas.
So the need for money for big ventures like colonization really pushed the development of shared ownership in these early securities. And now, fast forward to today, stock markets are pretty much everywhere, right?
Yeah, you'll find them in almost every developed economy and in most developing ones, too. The big players are in places like the US, the UK, Japan, India, China, Canada, Germany, France, South Korea, the Netherlands. It's a truly global network.
It really is. I remember reading a quote from the economist Murray Rothbard about the importance of stock markets. What was his take on it?
Rothbard, he was a big believer in free markets. He considered a stock market to be absolutely crucial for capitalism and private property rights. He said it's a market where those titles to the means of production can be freely exchanged. He believed you couldn't have true private ownership of capital without a stock market, and a socialist system couldn't exist with one. It really highlights how deeply connected the stock market is to a market-based economy.
That's a powerful statement. So beyond buying and selling shares, what are the other things the stock market does? Why is it so important in the bigger picture?
Well, for starters, it's one of the main ways companies raise money. When a company sells shares to the public, they get the cash they need to expand, invest in research, pay off debt, and do all sorts of other things. And while companies can borrow money through debt, the stock market lets them raise money without taking on more debt.
Right, so they can share ownership and raise funds without taking on more debt. Makes sense. What other important roles does the stock market play in the economy?
Well, a lot of people see the stock market as a kind of indicator of a country's overall economic health. When stock prices are going up, it often means businesses are investing more, consumers are feeling good, and it can also boost household wealth and spending. Because of this, central banks and other policymakers keep a close eye on the stock market and how stable the financial system is overall.
So it's not just a place to trade stocks. It also reflects and even influences the economy in big ways. What about the actual trading process itself? Are there other crucial functions that exchanges provide besides simply matching buyers and sellers?
Absolutely. Exchanges also act as a sort of clearinghouse for every trade that happens. So they oversee the whole process, making sure the trade details are correct, transferring shares from seller to buyer, and guaranteeing that the seller gets paid. This clearing process really reduces the risk of someone backing out of a deal, which builds trust and stability.
That's a huge part of maintaining confidence in the market. So how does this all contribute to economic growth in the long run? How does having a smooth-running stock market make things better for everyone?
Well, a well-functioning stock market makes it a lot cheaper for businesses to raise money, so they're more likely to invest and grow. And by allowing more people to own shares, it can also help reduce the risk companies face, which encourages them to expand their operations. All of this leads to more goods and services being produced, more jobs created, and ultimately more prosperity. And this is where things get a little more complicated, but there's this whole discussion among economists about whether bank-dominated or market-dominated financial systems are better for the economy.
So there's this ongoing debate about the best way to structure things. You also mentioned how the 2008 financial crisis led to more scrutiny of stock market structure, what they call market microstructure. What were the main concerns that came up?
Yeah, the 2008 crisis really exposed how interconnected everything is in the global financial system. It made people take a much closer look at the stock market's inner workings, all those little details they call market microstructure. They were especially concerned about whether certain structural elements actually made the crisis worse by amplifying systemic risk, which is the risk of one financial institution failing and triggering a chain reaction. This led to a much deeper understanding of how things like high-frequency trading, those dark pools, and the need for stronger regulation could impact things. And of course, the shift towards increasingly sophisticated electronic trading, which we've talked about, keeps raising new questions and challenges.
It definitely seems like technology keeps pushing the boundaries, and regulators are trying to keep up. Now let's dive into how stock prices actually behave. What causes those sometimes wild fluctuations?
Well, most price changes are driven by this complex mix of external factors. We're talking about big picture economic stuff like growth rates, inflation, and currency exchange rates. And what's interesting is that a company's intellectual capital, all their patents, know-how, and innovation definitely drives their long-term growth. But it doesn't necessarily directly impact their current earnings or stock price in the short term.
So it's more about the overall economic climate and how people are feeling rather than just how well a company is doing.
To a large extent, yes. And this brings us to something called the efficient market hypothesis, or EMH, which is a pretty big deal in finance. The basic idea is that at any given time, the price of a stock already reflects all publicly available information.
So if the market is truly efficient, it means you can't really find hidden gems or overpriced stocks because all the relevant information is already built into the price.
That's the core idea, but it gets a bit more nuanced. There are actually different versions of the EMH. The strong version says prices reflect all information, including private or insider info. But that's tough to reconcile with things like the 1987 crash when the market tanked for seemingly no reason. That kind of dramatic and seemingly irrational drop really challenged the idea that prices always make sense based on the fundamentals.
Yeah, a huge market drop with no obvious trigger definitely makes you question how efficient things really are.
Yeah.
So what about the semi-strong or soft version of the EMH? How does that work?
The soft version is a bit more, well, realistic. It says that stock prices reflect all publicly available info, so you can't consistently beat the market just by trading on public news or data. But it does acknowledge that there might be temporary weirdness in the market, mispricings, that you could theoretically exploit. The problem is they're unpredictable. You can't consistently make money off of them. And here's another interesting thing. While the stricter forms of the EMH say that price movements should be random if there's no new information, kind of like a random walk, a lot of studies have actually shown that stock markets tend to trend over weeks, months, or even longer. You hear people talking about market momentum all the time.
Yeah, like when investors try to ride the wave of stocks that have been doing well, right? That doesn't sound very random.
Right. And there are a few explanations for these non-random movements. Some research suggests it could be because investors' appetite for risk changes, or maybe because of the widespread use of trading strategies like stop-loss orders, which automatically sell a stock if it drops to a certain price. And then there are things like value-at-risk limits that institutions use. All of these could make the market overreact to certain events. But there's another really interesting possibility. Maybe stock price changes don't actually follow a normal distribution, that bell curve we all learned about. Maybe they're non-Gaussian, which means big, unexpected price swings happen more often than a normal distribution would predict. And if that's true, then the whole EMH idea might need some tweaking.
So the math behind the EMH might not capture the full reality of the market, especially those big swings. And what about all those psychological factors we talked about? How do they influence stock prices?
They can definitely lead to exaggerated movements, which goes against what the EMH says about irrational behaviors canceling each other out. For instance, we humans, we love to find patterns even when they're not really there. In the stock market, this means investors might see trends in random fluctuations or overreact to news, whether it's good or bad, pushing prices further than they should go based on the fundamentals. And when the market is doing well, it fuels optimism and makes people feel less risk-averse.
So it's like a self-fulfilling prophecy. Good news leads to more buying, prices go up, everyone feels great and buys even more.
Exactly. And then there's this other psychological factor called herding, where people just follow the crowd. It's hard to go against the grain, even if you think differently. Think about going to a restaurant. You're more likely to walk into a busy one than an empty one, right? It gives you more confidence. Well, investors are kind of the same. They're more likely to buy a stock if everyone else is buying it, even if the reason for the price increase isn't totally solid. That fear of missing out, or FOMO as they call it, can really drive market sentiment.
That's a great analogy. It really shows how human emotions and social pressure can mess with the market, especially when things are volatile. And I remember you talking about gambling earlier. How does that relate to market behavior?
Yeah, someone actually compared the stock market to different gambling games, which is a pretty clever way to think about it. They said that in normal, calm times, the market behaves like a game of roulette, where the odds are pretty clear and what other players do doesn't really affect you. But when things get crazy, when there's a lot of uncertainty, the market becomes more like poker. Now you have to worry about what the other players are thinking and doing. And this herding behavior, where everyone follows the leader, can really amplify those price swings, both up and down.
So it's like the rules of the game change depending on the market conditions. I love that analogy. Now, you also touched on the role of the stock market in transferring funds. Can you elaborate on that?
Sure. The stock market basically acts as a bridge between people who have extra money, the savers, and businesses that need that money to grow, the borrowers. And this efficient flow of capital is super important for a healthy economy. When people buy stocks, they're giving companies the money they need to innovate, expand, hire people, and ultimately drive economic progress. And all those big picture economic trends, GDP growth, unemployment, inflation, all those things, they all influence stock prices because they affect how profitable companies are, both now and in the future.
So the stock market isn't just reflecting economic activity, it's actively shaping it. I also remember something about Robert Shiller's book, Irrational Exuberance. What was a big warning about the market, especially back in 2005?
Oh, yeah. Shiller is a brilliant economist. In his book, back in 2005, he basically said that the stock market, based on metrics like the price-earnings ratio, was way too high historically. He said people were being irrationally exuberant, meaning they were too optimistic about future gains and thought they could get rich just by watching their investments go up. He warned that this overconfidence could lead people to make bad financial decisions and might even set the stage for a major market correction. And, well, he was right. A few years later, the financial crisis hit.
It's amazing how spot on he was. It shows how dangerous it is to let optimism take over and make us forget about risk.
Yeah.
And you also said that while news events seem to directly impact prices, the market's reaction can be pretty complex. Why is that?
Well, often by the time big news breaks, the market has already anticipated it and adjusted prices accordingly. So the actual announcement might not cause a huge shift, or the market might react based on whether the news is better or worse than expected. Plus, in the very short term, the market can be driven by all sorts of things: rumors, emotions, sudden fear or excitement, which makes it nearly impossible to predict those day-to-day or even week-to-week price swings with any accuracy.
It's a good reminder that we can't always connect a news story directly to a price movement. There's always more going on behind the scenes.
Yeah.
And lastly, on market behavior, you mentioned that behaviorists believe irrational behavior can create inefficiencies. What's the implication of that?
Behaviorists argue that when enough investors make decisions based on emotions or biases instead of logic, they can misprice securities. Basically, the price doesn't reflect the true value of the underlying company. And these mispricings, in theory, could create opportunities for savvier investors to profit by recognizing and exploiting them. But those who believe in the efficient market hypothesis say that all those irrational actions tend to cancel each other out, so prices are still mostly driven by rational decisions. It's a constant debate in finance about how efficient markets really are and how much human behavior plays a role.
That's a fascinating question. So let's talk about those scary market crashes. What defines a stock market crash? What are the signs?
A stock market crash is a sudden and sharp drop in stock prices across a wide range of companies. It's usually triggered by panic selling and a loss of confidence in the market. Crashes can also burst those speculative bubbles where prices have gotten way too high, detached from reality. The speed and magnitude of the drop are what really define a crash.
We've definitely seen a few of those in history. Which ones stand out as the most significant?
Oh, there have been several major crashes that have shaken the financial system and the global economy. The big ones that come to mind are the Wall Street crash of 1929, the 1973-74 crash, Black Monday in 1987, the dot-com bubble burst around 2000, and the 2008 financial crisis and crash. And more recently, we had the 2020 crash triggered by the COVID-19 pandemic. Each of these events had its own unique causes and consequences.
Let's touch on a few of those. The 1929 crash is legendary, almost synonymous with the Great Depression. What was the significance of Black Thursday?
Black Thursday, which happened on October 24th, 1929, is considered the start of the Wall Street crash. The Dow Jones Industrial Average plummeted that day, and the decline continued for weeks, wiping out a massive chunk of the market's value. It's considered a major trigger for the Great Depression, which had devastating effects for years.
A defining moment in history, for sure. What about Black Monday in 1987? People still talk about that one.
Black Monday, October 19th, 1987, was another dramatic day. The crash actually started in Asia and quickly spread around the world. What was really crazy was the huge single-day percentage decline. Markets in the UK, US, and Canada all dropped more than